Hey guys, welcome back. Today is our wrap up of 2021. It's been one heck of a year, and we're now in December. I want to recap on sort of where we started, where we're at now, and really what's in store for 2022. And keep in mind, we don't have a crystal ball. We have historical information to draw off of. We have some stuff that's going on in the US. But at the end of the day, my opinion is solely my opinion on where things are going, and take it with a grain of salt. In the U.S., there have been some strong movements. Inflation has been up. CPI is up, I think, 0.6% just last year. It's one of the highest increases since the early 1990s. The Fed Chair, Jerome Powell, has now dropped the transitory term from his vocabulary. So that's in relation to inflation. No longer is inflation considered transitory. And you may have heard this term when the Bank of Canada had announced their rate positions throughout the year and insisted that the inflation is likely transitory. So the US is no longer considering it transitory. The inflation might be here to stay. In the US, high inflation. We also have high unemployment. I think unemployment is hitting like 7%. Was the last time I took a look. 7% unemployment is very high. So when you have high inflation, high unemployment, that could lead to stagflation. That is a place you don't want to be because it's like a runaway train. Not only that, there's a lot of volatility in the stock markets. We also have companies like Better.com. They just announced a few days ago a layoff company-wide of 910 employees. 910 jobs were just axed. And Better.com is a large mortgage lender in the US. And what's happening is the refinance market is starting to dry up. So not as many people looking to refinance their mortgages. It's a little different there where the majority of the mortgages are open as opposed to closed like we have here in Canada. Okay, speaking of Canada, so a few things going on here. Inflation has jumped. So back in September, we were seeing inflation at around 4.4%. That's double of where the Bank of Canada wants to see our sort of key inflation at 2%. Now, they predicted 5% at the end of the year. We closed off November at 4.7% inflation, so fairly high there. With high inflation, we have to keep an eye on our variable interest rates. The reason being, unlike fixed rates, where fixed rates are tied to the bond yield, the variable rates are tied to the Bank of Canada's overnight lending rate. So they make these announcements throughout the year. Are they going to increase it? Currently, the interest rate sitting at 0.25%, so we're pretty much at the rock bottom. Is that going to move up? Well, it depends on who you ask. So BMO Economics has predicted about a 50 basis point increase by the end of the year. So we might see that go up to 0.75% as the overnight lending rate. And then TD Economics has forecasted upwards of 1%. So we're looking at just over about 1.25% for your overnight lending rate. What that essentially means is that your variable rate mortgages will increase. We're going to see it, but right now, as it stands, as we close out 2021, the last couple of weeks, there's been some really aggressive interest rate increases on the fixed side. So fixed rate mortgages are going up. They've gone up quite a bit since the Bank of Canada had stopped the monetary easing that they were doing. So there's no longer sort of like a artificial floor there to help support inflation. And the problem is if inflation gets out of hand, and we're seeing this with the Omicron, I think that's what it's called, the variant with COVID. We don't know how that's going to affect our economy. We don't know if it's going to close things down. We have issues with rail and logistics, transportation, shipping. The floods out west have shut down a lot of our ability to ship things quickly and efficiently across Canada. I know that Vancouver, that port there, for example, is the largest port directly trading with China, and we're predominantly an importing inflation. So that's of concern there. Basically, there's a lot of turmoil going on, but even with the predictions of variable rate mortgages going up, I still believe that variable rates give us the most flexibility for a few reasons. One, the spread right now is still fairly large, so at least 1% on average across the board, fixed versus variable. Taking into consideration the average mortgage amount for Canadians is north of $450,000. If you look at locking yourself in for a fixed period, you're now facing an IRD penalty, an interest rate differential penalty. That penalty is much higher when you compare that to a variable rate mortgage and the 3-month interest penalty. So we have a cheaper penalty if we need to pivot. So being flexible in a market that is essentially uncertain. So with variable rate mortgage, you do have the flexibility, and I think that's really important right now. Guys, like I said, I don't have a crystal ball, but by all accounts, the indicators are pointing towards higher interest rates. We're seeing it happen now. Going into 2022, we're likely going to see some rate increases as the government tries to battle our inflation, and they keep that in line by increasing our overnight lending rate. So as that rate goes up, the cost of money becomes a little bit more expensive, and it starts to cool things down, at least in theory. So we'll see where this takes us. Love to hear your comments or your predictions on where you think things are going to go next year. Like, comment, subscribe, and I'll see you in the next video.